Investors have been bearish on U.S. cable stocks since late 2021, and more recently, markets have corrected since Russia invaded Ukraine in February. This is creating a great buying opportunity for one dividend-paying stock in the sector. I'm Jonathan, and today we're going to look at Comcast Corporation, ticker CMCSA. Special shout out to ex-Dividend Dad for bringing this stock up in our Discord server. If you're interested in some great discussions regarding dividends and investing, check out the link in the description. But as you guys know, time is money, so let's get moving. Comcast shares are currently 26% below their peak in September 2021. And while this may feel like a red flag, as dividend investors, we know that that's not always the case. Comcast is a multi-year compounder with defensive qualities driven mainly by its U.S. cable communications business, but with good growth in NBC Universal and Sky as well. They ended 2021 with $116 billion in revenue, with just under $35 billion in adjusted EBITDA and $3.23 in adjusted EPS. And they have a very solid free cash flow of $17.1 billion. Xfinity, of course, drove the highest revenue and margin, but their subscriptions for NBC streaming service Peacock performed better than expected, and Universal theme park revenues are starting to finally see substantial recovery from the pandemic impacts. Comcast had a net add of 212,000 broadband subscribers in the fourth quarter of 2021, giving them a total of over 1.1 million for the year. They had their best quarterly performance for wireless lines as well, adding 312,000. For Xfinity specifically, revenue was up in the fourth quarter of 2021 by 4.5%, showing massive increases in wireless, advertising, business services, and broadband. And their net cash flow jumped almost 10% in Q4, showing solid improvement in growth. Comcast appears stable against new threats as well, which is promising. Although their net adds have been impacted by fixed wireless, it's not seen as a long-term threat. Comcast CEO Brian Roberts, appearing at an investor conference on the 7th of March, characterized fixed wireless as a lower speed, lower priced offering and stated that Comcast has not seen a material impact from it to date. I quote, "Time will tell, but it's an inferior product. And today, we can say we don't feel much impact from that. It's lower speeds. We've seen lower price, lower speed offerings before. We were the first company to get to 1.2 gigs of speed, and now, to my point earlier, offer that across the entire footprint. 2 years ago, about 28% of our customers had 300 megs or faster. Today, that's 55%, and 300 is relevant because that's about where fixed wireless tops out." Roberts also reiterated how Comcast has continued to compete successfully in broadband in general. He says, "Our broadband ability to sell and to increase value and get rewarded for that increase comes down to we've increased speeds. We also do things that are more than just speed, like the best Wi-Fi gateways and pods and streaming devices like our Flexbox, all for free and for no additional cost in many cases." For speed, Comcast is on a pathway to upgrade its network to DOCSIS 4.0, which will enable a 10 gigabit per second download speed or a multi-gigabit per second symmetrical speed competitive against fiber. Comcast has also improved broadband retention by bundling wireless services, which gained 1.15 million subscribers and turned profitable in 2021 with a full-year EBITDA of $157 million. For 2022, Comcast expects to be even more active in increasing its number of serviceable passings and to aggressively compete for market share. Even with these investments, management expects to be able to keep CapEx intensity as a percentage of revenues in cable comms at around 11%, similar to 2020 and 2021 for the next few years. While the NBC Universal portion of the business saw a drop in EBITDA due to higher programming costs and higher marketing costs, they still saw substantial increases in revenue, and I believe Comcast took the hit in EBITDA now to establish itself moving forward in those areas. Media revenues grew 9% year over year in 2021 and were 12% higher than in 2019. However, its EBITDA fell by $90 million, primarily due to losses at Peacock, driven by programming charges. Media faces declines in cable TV viewership and streaming competition, but contributed just 13% of group EBITDA. With Q4 results, management announced Comcast will be doubling content spent on Peacock to over $3 billion in 2022 and ramping it up to $5 billion over the next couple of years. This does mean an expected 2022 EBITDA loss of roughly $2.5 billion, and the timing of when Peacock breaks even may be pushed out from where they originally expected. However, revenues are also expected to grow significantly, which means losses are expected to peak in 2023. Studio revenues grew 36% in 2021, partly helped by new exclusive content agreements with Peacock and exceeded 2019 levels. However, EBITDA fell primarily due to higher TV production costs and marketing expenses for theatrical releases after the COVID-driven reduction in 2022. Theme parks recovered strongly in 2021 thanks to reopenings during the year. Revenues rose 191% year over year, but were still 12% below 2019, while EBITDA was approximately half of its 2019 number. Among existing parks, Orlando and Hollywood reopened in Q2 and have been operating on full capacity and strong profits since Q3. Japan also reopened in Q2 but had restrictions throughout the year. The new Beijing park opened in September and was essentially break-even in Q4 and expects modest profitability in 2022. And finally, the Sky portion of Comcast business shows an overall revenue decrease of 2.5%, but surprisingly just under 200% EBITDA increase year over year. In 2021, reduced Serie A football broadcasting rights in Italy meant lower direct-to-consumer and content revenues in that market. Nonetheless, total direct-to-consumer and advertising revenues both rebounded from the prior year COVID-driven declines. Content revenues and customer relationships fell, both due to losses in Italy, partially offset by gains in the UK and Germany. Management reiterated their confidence in doubling Sky's EBITDA in the next couple years from the 2020 levels. Overall, Comcast EBITDA grew 12.6% and group free cash flow grew 25% in 2021, excluding a $670 million benefit from a bond exchange. At $45.54, Comcast shares are trading at a 14 times PE and a 7.2% free cash flow yield. Comcast pays a dividend of $1.08, which was raised 8% in 2021, representing a dividend yield of 2.34% that's been growing at a clip of just under 13% per year over the last 5 years, and they've paid dividends for 13 consecutive years. Net debt to EBITDA was at 2.4 times at 2021 year-end, and management has indicated that it's expected to stay at this level in the next few years, implying that all free cash flow will be returned in dividends and buybacks. Comcast bought back $4.6 billion of its shares in 2021. And in case you didn't know, Comcast owns a 33% stake in Hulu, which is subject to a put-call option with Disney exercisable in January 2024, with the value to be determined independently, but at a minimum value of $9.17 billion. This definitely shows more upside for Comcast as well. Now, based on the latest forecast and keeping the similar numbers for cable comms, but reducing them significantly for media and theme parks, we can see the following estimates. 2022 to 2024 cable comms EBITDA growth to be around 6.5%. Media EBITDA to fall $1 billion in 2022 and $750 million in 2023 and then stay flat. And studio EBITDA to be $1 billion in 2022 and then grow at about 6% annually. So for theme parks, we'll see $2.5 billion by 2023 and then grow at 10% annually. Cash interest expense should be about $4.5 billion in 2022 and then grow at 7% per year. And last, we have CapEx, which they expect to grow at around 7% per year. Using these numbers and making the following assumptions outlined by Librarian Capital. Number 1, dividend payout ratio would be around 31%, improved from 32.5%, and the share count would be reduced by 4.5% per year based on Comcast's own direction. We'll arrive at a free cash flow per share of $4.11. With shares currently at $45.54, this would give us a share price around $74 and a total return of 71%, which is around 15.7% annualized by 2025 year-end. Comcast has been a good company for a long time, and today's price, coupled with the company's direction, provides a great buying opportunity in my opinion. Thanks for hanging out with me today as we took a closer look at Comcast Corporation. If today's video helped you out in any way, pop that like button and subscribe to join the Cash Flow Nation. I'd also love it if you dropped a comment below and let me know what's your favorite stock that's taken a recent hit. And if you're curious what it would take to earn $100 a month in dividends, check out these videos on the right. Thanks and see you next time.